So stocks well off session lows, gaining steam into the close. The Dow was down 340, 350 at the low of the session. It is now flat. And Mike, I guess shrugging off some bad earnings as well overnight, certainly some bad reactions to earnings, and strong data that could have pushed yields quite a lot higher.
Yeah, yields sitting it out. So it seems like people feel like we've priced in what's likely to happen Fed-wise at this point, even perhaps with inflation, leading indicators of that peaking out. And then, you know, if you take out the idea that it's very evident that we're still in selling rallies mode in the big, expensive stocks and some of the pandemic favorites. Outside of that, you know, again, I keep pointing to the equal-weighted S&P. It's almost, you know, like 4% below its high. It's outperforming this week, this month. So it seems like there's a little bits of traction, even though overall market still has plenty to prove. We're still, you know, about halfway, or not quite, between the lows and the highs of January. Non-committal at this point.
And for the first time, we really got a reaction from Fed minutes or from anything Fed-related that was not considered more hawkish than the market thought, because the market has gone a long way to pricing in 6 interest rate hikes this year, half of, 50 basis point hike in March. Market getting ahead of itself, maybe?
Or at least fully priced for it. I mean, it's interesting because, yeah, you took 3-week-old minutes from the Fed meeting where it didn't show a huge sense of urgency. I think the market wanted to make sure that Bullard talking half a point and getting to 1% of hikes by July 1st was not somehow conveying the middle of the committee's thinking back in January, which is not the case.
Josh, does the fact that these Fed rate hikes are so clearly priced in at the moment make a massive amount of difference, or is there still going to be volatility to come as they actually go?
I promised myself I wouldn't do this. I said I wouldn't do this, but Will,
what an actor.
This could be your last question to me. So
I have a feeling, despite the elongated answers, I'll squeeze one more question in.
All right, fair. We'll make this the second to last, my friend. So I think Mike mostly has it right. We're kind of in a no man's land. We're somewhere between the lows and where we started the year in a lot of names. And even when I look at some of the stuff I'm invested in, there are really only 2 categories of stocks that are at their highs and looking great. One is anything related to Omicron going away. So you could cite a lot of travel names that have held up well this week. I would point to Live Nation, probably the best looking stock that I own personally. So anything that's related to just this idea that we're finished with lockdowns and we're almost finished with masks, we're finished with vaccine requirements, like all of that is within 90 days of dying forever. And those stocks are reflecting that. The second type of stock that's doing well is Berkshire. Here's a company that has all of the assets you would want for the current economic environment, plus $150 billion worth of cash to do whatever they want with. And that is, to me, like a battleship, a fortress in this market. Outside of that, really, there's not a lot that looks great. Even a day like today, the minutes doesn't give you any reason to be more worried. Stocks get a little bit of a lift, but you really don't have a big or an expanding new high list. And I think that's probably going to lead to a lower high, especially in NASDAQ names. And that's what a lot of people are concerned with right now. The possibility of a lower high before we start to sell off again, or even a head and shoulders for the S&P 500. Those are still legitimate concerns given how weak the bounce has become.